crowdfunding, I think we have it actually on the next slide. So crowdfunding is, it's now officially in the dictionary, right? So it's practice of soliciting money from a lot of people. That's essentially what crowdfunding it is. And so think back, I don't know, many, many years ago. Think back even into the 40s or 50s or 60s. Typically, and this is, if again looking at it from a real estate perspective, but think about, for example, a very large commercial building in Philadelphia, or a very large commercial building. Think about the Empire State Building in New York City. The thought was, or the practice was, and in fact the practice continues to be today, that only very, very wealthy individuals or very large corporations or funds or real estate funds can own and invest in very large buildings like that, because they cost a lot of money. They cost, today hundreds of millions and billions of dollars. And so the only people that have that kind of financial wherewithal are either very, very wealthy individuals, big banks, large funds, or large corporations. What Mr. Helmsley and Mr. Wien, his partner, did back in the 70s is they decided, you know what? Yeah, we're all kicking, I don't know, $30, $40 million of our own money, or money that we manage, but we're also going to go out and we're going to raise money from thousands of small people. They're either our friends, or they're our friends' friends, or they're friends' friends' friends, or the people we don't know at all. But people who have $1,000 to spare, it was actually $10,000 was the minimum, $10,000, they raised $36 million from 3,600 individuals, $10,000 apiece. And they funded half of the purchase price for the time, the Empire State Building, and they bought the Empire State Building. And those people who never would have been able to invest in an asset like that with $10,000, would never have there were no opportunities even then to invest in companies that owned assets like that. They ended up being sort of one of the first what we call crowdfunded buildings, in the sense that this was a building that was financed with thousands of small contributions by lots of people. So let's just take a step back when you talk about raising money, because that's, I think, what it all gets down to. In our country, and in every country, business, enterprise is in large part about a good idea, a great management team, great, I have gold in the backyard, or I have gold in my computer, or whatever, whatever you have. And then it has to be paired with some kind of money to get it out, to produce it, to sell it, to market it, to advertise it, to develop it, right? There needs to be a combination of really good idea and money, right? So you have drug companies who are spending lots of money developing, and then when they have the drug, they cost them 2 cents to produce the drug. But there's always a combination of finance and good ideas and good people. I mean, think about even when you go and buy your own home. I mean, think of something closer to home. When you go to university sometimes, there's a combination of good grades and great essays and getting into school, and then the financing part of it comes in. So there's usually some part of the money that has to be found somewhere to pay for developing, producing, selling, monetizing really the good idea, whether it's IP, whether it's real estate, whether it's furniture, whether it's software, whatever it is that you want to do. Getting that money has always been hard. Some people were, fortunate; they were born wealthy. They had a lot of money, and so they used that money to fund what it is they wanted to do. Some people, think back in the Roaring '20s, had good ideas, and they went and they advertised, and they said, "I have a really good idea. Call me here and invest money in my good idea." And people would invest money in the good idea, and turned out that the good idea wasn't that good idea at all, and everybody lost their money. And then, sometimes they sued, and sometimes, but usually, when it wasn't a good idea, the money was just gone, and there was really nowhere to go and get it back. And so in the 20s, you had this sort of Wild West, where everybody was selling good ideas and speculative properties and investments and stuff in exotic locales and all kinds of stuff that led to the the stock market bubble that we ended up with, the crash of 1929, all of that was about, there were two things. There were genuine companies trying to raise money to fund operations, fund whatever. And then there were a lot of fraudsters, people who are just, it's a free-for-all. I can advertise, make money. People give me their money. I can convince them of anything I want. I'll write whatever I want, and then I'll abscond with their money. And so because of that, we in our country and virtually every other Western country develop laws that don't permit people to raise money. And by raise money, I mean to sell securities. And we'll talk about this. So to raise money means, here I have a company. I know how to make furniture. I need somebody to invest to help me build a factory and buy wood. So you give me $100, I'll give you 1/10 of my company. Or I'll give you 1/16 or 1/100 of a 16th of my company. I'll give that to you in a form of a security. Usually that security is a share, common stock. Right? I'm buying security. But it can be any kind of, it can be debt security, it could be a partnership interest, it could be whatever it is. But let's just it's an interest in whatever it is that you're buying. So that when then I manufacture the furniture and I sell it and I earn some income, 1/16 or 1/10 of that income really is yours, because you have the part ownership in the company. So we have what we call the Securities Act, that you may know of, that essentially very severely limits and restricts the ability of anybody to raise money from sort of the public, right, without going through a very expensive, time-intensive, and arduous and time-consuming SEC registration process. This is what's known as a prospectus and registration and financial statements and auditors and legal opinions and comfort letters. This is a big process. That's why an IPO is a big deal, because it means that the company has been vetted by bankers and by lawyers and by accountants and by the regulators, by the SEC. That's why the vast majority of companies that need capital are not advertising in the public for that capital. They're going to the banks and getting loans. They're going to their friends and getting loans. They're having very small capital raises. There's only a very, very small subset of business enterprises in our country and in any country that are publicly registered and traded on the stock exchange. Why? Because it's a big deal to do all that. You have to file registrations. You have to have accounting audit. There's constant time and effort associated with being a public company that most companies don't want to do. And so fast forward, the 30s, the 40s, the Great Depression, the 60s, all through that time, we sort of had the same regulatory structure in place. You can't raise money from the public without going through this very intensive SEC registration. We do have, and we've always have, what we call a private placement exemption. If I'm a fund, if I'm a software engineer and I have this great product, right, that I think I'm going to be able to sell, let's call it Instagram. I've come up with Instagram, right, and I think it's going to be awesome. And I'm not yet ready to go public and raise money from the public to develop. So I go to my friends, or I go to, I don't know, maybe I call Goldman Sachs and I say, Goldman Sachs, I have a really great software product here. Let me talk to your software bankers. And they say, yeah, this is a great product. We will bring to you 10 or 20 sophisticated investors who typically invest in internet startups or in software startups. They will each give you $20 million, right? So then you'll have $100 or $200 million to work with. And that, again, for those who don't know, this would be like a series financing. This would be like an angel round financing. The different buzzwords that are used. But essentially it just means I'm getting money from my company, not from the public at large, but from a select group of sophisticated investors. Our rules, as do the rules, again, of most Western countries, say that transaction doesn't require all the prospectus and drafting and IPO and registration and account. All that doesn't require it, because these investors don't need our protection. These are very sophisticated. Anyone who can invest millions of dollars, they don't need the protection of the SEC. They don't need the protection of anybody else. They're sophisticated investors. So that's what we call our private placement exemption. And a private placement exemption works if I raise money from a select group of individuals who are sophisticated investors, and I do not advertise generally my business or my fundraising initiative to the public at large. And that is known as, again, this is just industry jargon, and I don't have my back to you because I don't like you, it's just most of it. That is known as, it's just a buzzword, but general solicitation or general advertising. In order to qualify for this exemption to the very intensive and costly registration, you cannot engage in general solicitation advertising. You can't be, which is very broadly defined, but again, you got to think about why this is. We don't want people to be raising money from the public or telling the public generally that there's a fundraise going on that maybe they want to get involved in or maybe they want to invest in, unless somebody can vouch for the veracity of the business. It's not just fraud, right? That's why we have this registration process in the SEC, which is a very large government agency in place, because we're trying to help, me and you, small investors, not be defrauded. And so if we allow people to go out and generally solicit and generally advertise for their businesses or for their good ideas without any regulation, we're afraid people will be defrauded. And so you can only have these little investments to fund from like sophisticated investors only if you're not out there generally soliciting general advertising. And so a long time ago, when these rules were made, like a very long time ago, it was pretty easy to define what general solicitation advertising means, because there weren't so many ways where you could reach the public, right? There are radio ads, there's newspaper print, and there was, later on TV. But that was sort of the only way you could really mass market. I guess there were mass mailings or telephone, With the advent of the internet and electronic media, it becomes very easy now for anybody with a computer and a modem to mass market, right? I could put up a website that says, the Yoel Kranz investment company, and I can make up returns and say I have, 38% annual returns for the last 10 years, and I can show financial charts, and I could have links to PwC's website and to the SEC's website. I can do whatever I want, right? Because it's a free world. And I could say, click here through your PayPal account or whatever other account to invest in my stock. So I'm generally solicited because it's available to anybody who has an internet access can get on my website, right? Anyone who has a PayPal account can invest. And for all anybody knows, it's utter and complete fraud, right? Which of course it is, because I have no company and I have no, but as you know, with the Nigeria, right, the Nigeria emails, for every 99 people that put it in the spam box to delete it, there's one person who says, oh yeah, and invests. And there are people who are in the business of doing this, right? And so now we get to crowdfunding. So the pendulum sort of swings. Think about our economy, right? 10 years ago, it was good, and 5 years ago it was terrible, and now it's a little bit better. And also the administration changes, right? Sometimes we have a Republican administration that's all about let people do whatever they want in finance, the capital markets rule, if people who invest in a sufficient number of fraudulent investments will be more careful the next time. That's sort of, a hands-off approach. And then there's, the more government will take care of you approach, which is, we'll put in so many rules and regulations, and we won't allow banks to do this, and we'll only allow banks to do that. And so there's been swings of the pendulum over the years as to how intense the regulation is and how much it's enforced. And so a number of years ago, after the crash of 2008, 2009, we had a very significant, at least from a financial or business perspective, piece of legislation pushed through Congress called the Jobs Act, the Jumpstart Our Small Business Act. And that one, in addition to other items that we're not going to discuss today, introduced the concept of crowdfunding. And the thought is, I'm a small business, right? The vast majority, you read it all the time, the vast majority of our business in this country, the jobs in our country, come from small businesses. It's not from the Fortune 500 or even from the Fortune 1000. It's from the small operations, the 5 employees, the 10 employees, 15 employees, that is in every city, in every town, in every state. That's what generates the vast majority of business activity in our country. With all of the regulation that makes it difficult for small businesses. Again, I'm using furniture as an example. Small business, I've got a little furniture shop or furniture manufacturing facility. I need some money. The bank, I've already maxed out on the loans. The bank says if they want to, again, for every, you know the concept of there's leverage, which is debt and equity. So the bank is only going to lend you so much. The bank, you know, if you need $100 to buy a business, the bank is likely to lend you 50 or 60, and then you have to put in 40 or 20, 30, 40 of your own, or of equity, yours or somebody else's money, to counterbalance the bank. And so if I need some money, I can borrow as much as I can borrow from the bank, but I'm a small business, I really need access to capital. And so the purpose of the Jobs Act was to make it easier for small businesses, not big public companies, not companies that have lots of lawyers and accountants on call and who can always file documents and do stuff. Just small companies who need ready access to capital. And you know, in our day and age, that also includes a very large number of startups, maybe all startups. Smaller companies don't have a track record, can't really file an IPO with the SEC because they don't have the track record, they don't have the money. They haven't even developed their idea properly yet. But they need capital, they need some investment to help them do that. So how do we do that? And so the Jobs Act idea was, well, the Jobs Act was, this is what we're going to do. We're going to open up, this age-old ban that we've had on being able to generally solicit and generally advertise. In other words, the age-old ban that we've had for decades and decades that says if you want to raise money privately without going through an expensive SEC registration that you can't advertise, you can only go to very specific people whom you know are sophisticated investors, we're going to lift that ban. We're going to say, if you're a small company and you want to raise capital, take an ad out in the Wall Street Journal. Say, invest in my company. I'm the best company in the world. I'm going to return 100 cents, 100% every year. Invest in my company, and click here or mail in here if you want more information or if you want to invest in our company. With the catch being, right, so how do we know it's not all fraud? The catch being is that you can actually only sell to people who are what we call accredited investors. These are people who have earned at least $200,000 in each of the last couple of years, or people who have a net worth of over $1 million, not including equity in their house. So these are not hugely wealthy people, but they're people who are deemed by Congress to be sophisticated enough to look out for themselves in terms of what they're investing in. So you can't go to poor people. You can't go to pretty much the vast majority of wage earners in our country. But there's some layer of people above that who have a net worth of more than $1 million, who have been earning $200,000 or more, whom you can just advertise for. You can, again, the Wall Street Journal, right? That's a pretty good medium because the readers of the Wall Street Journal, there's probably, I don't know what percentage of the readers of the Wall Street Journal fit that category of accredited investors, but probably a significant number. There are any number of places where you might go and advertise in trade journals and financial magazines and the subway stop that's right near the financial district or in downtown of cities. You can do whatever you want. You can advertise to whomever you want, whenever you want, so long as you actually only sell securities to people whom you can verify, and this is the key, you have to verify that they're sophisticated investors. And so that's sort of the watershed or the revolution of the Jobs Act, that it allows people to literally go out on the web, and this is really what it's about. It's about the web, the internet, and advertise and say, I have a great product, I have a great project, I have a great IP, please invest with me. There was a keyboard here a minute ago. This is why you shouldn't invest with me. Okay. So I'll just take a look here and see where we are in the industry now. And so, as you see the numbers here going up and up and up, this is how much money is actually getting crowdfunded. This is real estate particularly But this is how much money is getting crowdfunded. And look at the various, these are called companies, or really they're called platforms. And so Kickstarter, or Indiegogo, which many of you may know, that's a type of crowdfunding website that helps companies or individuals raise money, but doesn't implicate really at all any of the things we've been talking about the Jobs Act or the securities laws or SEC, because they don't give back shares or percentages in the company in return for your money. They give you free coffee. You know, I literally just did that myself. I live in the Bronx and in Riverdale, and there's somebody who sent around, I don't know how I got on the email, but sent around an email to everybody saying, I would love to, you know, raise money to open up this gourmet coffee shop in the neighborhood, but we don't have one. Wouldn't it be great if we had one? I was like, yeah, it'd be great. Well, click here, $25 in PayPal, and if you do that, you get like free coffee. You know, you'll get free coffee at the grand opening or something. And so, you know, and this person raised something like, I don't know, $50,000 doing that. So it's a lot of free coffee, but you didn't sell anybody security. And there's a lot of companies that do this, by the way, and they'll give you a free watch, or they'll give you access to an event. Kickstarter raises a lot of money, for example, to fund films. People who are trying to produce a film and they need money. You can contribute to the film, and then you have access, you know, free tickets to the premiere in the city of your choice, or something like that. So that's the way of crowdfunding that doesn't involve any of the securities laws, because you're not actually issuing securities to anybody. You're giving them free gifts. Then there are charitable sites that allow you to, you're not looking for something in return. It's a charitable contribution. So crowdfunding, as it were, by charities is actually a huge, you know, you go to the United Way, you click on the United Way, you can invest. No problem there, you can invest. You can invest in United Way. It's not for a return that you can count in money. It's a spiritual return, it's an emotional return, but it's not something that we regulate.
Other than you have to be a charitable organization.
If you want to, right, but you don't, in other words, you don't have to be. Right? In other words, you could also just be, it's not tax deductible, invest in me anyway. Right? I get people knocking on my door all the time saying, I don't have any tax deductible, but I really need $50 for dinner. Okay, right? So, and you can't deduct that, but you know, it's charity. In other words, but no one's calling the SEC on those folks, right? Because people are giving money, they're not making an investment with the expectation of a return of some sort. But then we go to the true crowdfunding, and to be perfectly technical, which is, I'm sure none of you care about. It's what we're talking about here is really called crowdsourcing. Crowdfunding, and I'll just get rid of it right now. Crowdfunding, and we'll use the terms interchangeably. Crowdfunding, which is part of the Jobs Act, those are rules that actually have not yet been implemented. The true crowdfunding, because the true crowdfunding was meant for really, really small businesses that could raise money from anybody, even non-accredited investors, but only in very micro amounts. So you could raise, for example, from a non-accredited investor, $5,000 maximum for a year, right? And the whole business as a whole could raise from anybody, everybody, maximum $1 million. So that's the true crowdfunding. Those rules have not yet been implemented, but that's not what we're talking about here. So we're talking about, we call it crowdfunding, but truly it's crowdsourcing, which literally means I'm raising money from people who are sophisticated, because at the end of the day, I want to raise more money to fund my business. I need more than $5,000, $50,000, and therefore, I'm only looking at people who can invest more than $5,000 a year. So then we get to the different kinds of, and let's jump to the last one because it's actually interesting, the P2P lending. P2P lending is fascinating. Imagine, and this happens every day, imagine, you apply to law school at, hypothetically Villanova, and you get a scholarship, or you get a partial scholarship, but it doesn't cover all of your costs. And you max out on your, I don't know what they're called anymore, Pell Grants or Stafford loans or whatever they are, and now you're short $10,000. Right? You're short $10,000, and you've already called all your uncles and aunts. Where are you going to find $10,000? So you can go to a bank. The bank will give you a loan with some rate, and the bank may or may not give you the loan because you're a young student, don't really have any assets to collateralize that loan, and maybe you already have too many loans. Again, I'm purely hypothesizing here, but I'm just talking about trying to put, there's somebody who needs money for a legitimate reason. They can't get it from regular sources, or can get it only at a very high cost. P2P lending is sort of like P2P file sharing, right? It used to be that if you wanted a song, from fill in the blank, right, then you'd have to go buy one in the store from Barnes & Noble or from whoever, right? P2P allows somebody else who already has that file to share it with you, right? This is illegal in many places. But the concept of, it's called I can't even pronounce it properly, disintermediation. You're cutting out the middleman. Right? It's supposed to be there's the artist produces the goods, gives it to the retailer, who then sells it to the public. Right? If the public just distributes it among themselves, right, then you have the artist and you have the public, but the guy in the middle who's making the money and taking the commission, right? It's the same with books or really any merchandise. The person in the middle who's getting the markup for being the retailer, for being the person who's passing it along, is getting cut out of the equation. And that's what P2P lending is, and it's actually fascinating, and it's growing. So what you do is, there's another one, patch of land, that we actually represent. But you call patch of land, and there's forms you fill out, and you say, I need $10,000. It's going to be used to pay my college tuition, and these are my assets, or these are my whatever, and this is the rate that I'm willing to pay. I'm willing to pay 8% or whatever it is. They will then post that. They'll probably call you, have a couple verification sessions. They will then post that as an investment opportunity on their website. And somebody who is looking to make some extra money on the side, and there are millions of such people, go to this website and they sort through, and they say, I'm looking for a less risky investment paying between 5 and 10%. And they click, and your loan that you've put on the site is one that pops up. And then I can decide, yeah, you need $10,000. I'll put in $500 towards your loan. And then if enough people do that, and you've already told them that I'm willing to take minimum $8,000 or whatever it is, if enough people get there, so you have a funded loan from any number of people up to $8,000, then you get your loan. You get your loan for $8,000. You have to make payments, and you make them through this platform, and the platform then distributes it out to all the different investors. So you get your loan, you get it at the rate that you wanted. The people who are investing in you get a loan that they like based on the parameters that they've set themselves, based on however they've searched. So again, just because you're not buying an interest in a company doesn't mean it's not a security that sort of gets regulated. It is a security because you're buying something that pays something. That's a security. And it is regulated, but because so then we take a step back. All of those investors that wanted to get on the website and look for loans, they can't just click on the website and look for loans. At least they're not supposed to. We can talk about that. They need to be vetted, right? Because remember, you can't publicly sell securities other than to accredited investors unless what? Right? Unless you're registering with the SEC. The whole point of this is that we're bypassing the registration with the SEC. We're bypassing audited financial statements. We're bypassing accountants and lawyers and bankers and we're bypassing all of that. And we're going straight to the investor. I'm saying, invest with me, and I have nothing to show you, other than, my acceptance letter from the school. And please fund. So anybody who gets on that site, and this is the key here, anyone who gets on the site to invest, they first have gone through a vetting process. The site tells them, please fill out this form. It tells me how much money you've earned, what's your net worth, are you an accredited investor, where do you live? Sometimes they ask for more, sometimes they ask for less. But there's some process by which they vet. Then there's this pool of 100, 1,000, 10,000, 20,000, million of accredited investors who can then log onto that. They have to put in a password, right? Because again, whenever you get on a site, and the site is not password protected, then that's called generally soliciting, generally advertising. If it's available to anybody with an internet connection, then it's a public advertisement. If it's a public advertisement, We have trouble unless, again, under the Jobs Act, you're willing to verify by looking at people's tax returns whether or not sophisticated. We'll talk about it in a second. But here we're talking about you can't get on the site and look at the investments or invest until you've been vetted as somebody who's a sophisticated investor. You do that, you get on the site, then you can look through and you can invest in whatever, in whatever you want. So that's P2P lending. P2P lending allows borrowers and lenders to be matched directly over this platform, over this site, and it's taking off in a very big way. Right now it's smaller amounts, but it's taking off again, larger and larger. Then I'll stop and catch my breath. So then just going to the equity piece. So that's debt securities or lending. But then there's also regular investing in the business for stock, for a piece of the action, right? And Realty Mogul or Fundrise are two of the examples that are on here. But again, it's the same thing. They allow you to, both of these sites are what we call multi-issuer platforms. They're not, Fundrise doesn't sell securities in Fundrise. Fundrise allows you to invest in other people's projects, and they take a commission, or they do the processing, or they do the verification. They're a platform. Same thing with all of these sites are platforms. Kickstarter is not selling you interest, or they're not giving you coffee for investing in Kickstarter. They're giving you coffee for investing in the local cafe or whatever it is. And so these are platforms that post other people's things. So for example, Amazon.com, right? Amazon.com is the largest retail in the world, right? Other than like the Kindle or a very, very small number of products that Amazon is selling or manufacturing itself, Amazon maybe isn't a bad example. Let's use eBay as a better example because Amazon is factory. But eBay is a platform by which other people can sell things to you. eBay is not selling you anything, right? So you've got to think about these as the same way. These are platforms by which other people can sell investments to sophisticated investors. And there are a variety of ways to do that. That's called, those are the multi-platforms. What if, think about this. You have a very sophisticated product, right? You're a, Swiss watch manufacturer. You have a very sophisticated product. Do you want to sell your watch on eBay? The answer is, for purposes of this discussion, the answer is no, right? Because eBay is down market. It's people are looking for the best price. That's not my target demographic. I need people who want to pay top dollar, who like a lot of frills instead of, so therefore I want my own site. I want my own site that sells my own watches. And you can't negotiate, and you can't, I want my own. So how do I do that? I could hire software engineers, and I could build my own site, and, or, right, you have to know this term, it's called white labeling, right? I can go to any number of white label web e-commerce service providers, right, and tell them, build me a site based on your 10 templates that you have out of the box, put my name, Swiss watch manufacturer on the top, and create a customized site for me, but it's based on one of your out-of-the-box templates called a white label product. You go to the grocery stores around here? You go to Giant. You go to Giant, you buy Giant brand margarine. There's nobody in the back in Giant making the margarine, right? They're buying it in bulk from a margarine manufacturer who manufactures margarine for 1,000 different stores. And then they have custom blends for different stores, and then they just wrap the Giant label on the product. This is the same. So I go to a website provider who provides website interfaces, and I say, so again, going back to equity, if I don't want to sell interest in my company on Fundrise or Realty Mogul or some other site that has a bunch of other kinds of companies, I want mine to be special because I'm looking for higher price investors, I'm looking for a more focused, whatever it is I'm looking for. I want people who Google, they should Google, sophisticated, high price, best kind of, that's when I want my site to come up. I don't want the eBay or the Fundrise or the Realty Mogul to come up. So I hire someone else to do that. who do I have to hire? I have to hire software engineers. I have to hire a broker-dealer, because the broker-dealer, again, we're buying and selling securities. Not everybody can buy and sell securities. You need a broker-dealer who's going to be licensed to buy and sell these securities for you with your investors. I need some kind of money management system that will be able to take in money and pay out money. There's a bunch of people and different service companies that I need to create this site. But once I have all that in place, I can advertise to my target demographic. I can sell them interests in my business. I can take their I can take their money, and I can do it over and over and over again until my company becomes so large that it does make sense for me to become a public company. It does make sense for me to become listed and go trade on the New York Stock Exchange, and then anybody can just buy my securities on the exchange. Or, which is more likely at this moment, there's a fantastic blow-up and bankruptcy, and you have to go change your name and start again somewhere else. And so that's really what people are waiting for in this space. I've been talking a lot, I'm going to stop now, but what people are really waiting for in this space, and maybe that's something that some of you guys are thinking about, is, geez, sounds like in some way we're going back really to the Wild West, when everybody can sell whatever they wanted to anybody, and there was really no regulation. And there's no question that there will be, there will be some bad apples. There will be some people who are going to take advantage of the relaxed rules and the ability to target and market to anybody. Right? You're always going every day on the way. If you just read CNN, if you just read the New York Times, you can just be on fine, straight down middle of the road websites, and there's always ads that pop up that say, lose 50 pounds in an afternoon, or here's, make $1,000 every night at home. There's always, because people are paying a lot of money for placing those ads in Google, the New York Times, and places, because they know that some people are going to click on them and some people are going to invest. And that's really what people are waiting for in this space is, we're trying to keep it on the up and up. We're trying to vet investors. We're trying to vet providers. We're trying to vet the back office, the white labelers. We're trying to make sure that it's all kosher and that everybody is in good faith. But somewhere, somehow, in this process, you can be sure somebody is going to sell some securities on the basis of misinformation, and people are going to lose money, and there are going to be lawsuits, and that is almost always what causes the government to move. The government, as I said, the pendulum moves in reaction to the economy and in reaction to complaints from constituents. And so the more people that lose money in these kinds of arrangements, the more people are going to complain to their elected officials, the more you're going to see the pressure on the agencies and on the government to crack down and to take away with, so the giving, right now we're in the giving mode. You don't know where the government might be, next month, next year, in 2 years when some of these spectacularly fail. I think that's sort of the way all new types of enterprises develop. You have, think about all the startups of the 90s, the internet startups, right? Some of them were spectacularly successful, right? Think about the Googles and the Yahoos or whoever. Some of them were, probably the vast majority of them were spectacularly unsuccessful, right? But that's part of our system. And so there's going to be a lot of these, I think, that will be unsuccessful, and either they'll run afoul of some rule, or they'll be not particularly scrupulous about vetting investments, or they just won't be good at it, and so some of the investments will fall through, and enough investments fall through, enough people are disgruntled, nobody will invest on your site anymore, right? Again, I go back to eBay, because eBay is a really good example. Too many people have bad experiences buying on eBay. I paid, I didn't receive it. I paid, I received something else. I paid and came to it. Whatever it is, too many people have that experience. You don't buy on eBay anymore. Right? And eBay knows that, which is why they're giving guarantees, and which is why there's the PayPal system, whatever it is, to make sure that it's a true and it's more or less a workable and something you can have confidence in. And that's really going to be the key to all of these, is to make sure that when people invest, there is a return, there is accountability, there is transparency. You can actually look and see what the business is doing. It's not just maybe a check comes in the mail one day and maybe it doesn't. That's how these are going to play out. So we're really in the infancy stage of these, where They're growing, they're expanding, they're pushing the envelope. How much can we actually advertise? How many people can we really just troll the web, and take in people's money? How much can we do? What can we get away with? And how long can we get away with it before the rules change again and we can't do it anymore? So that's all that's going on right now. So it's not a mature industry. It's growing, it's expanding, it's developing. I think we're going to see a tremendous amount of growth and the emergence of some very big players and successful players over the next, 3 to 5 years. So now I'm quiet.
Now it'd be probably a good time for questions if people have questions.
Any questions?
I had a question. What's the status of the regulations under the Jobs Act? Because you mentioned that there was going to maybe be some sort of carve-out for people who aren't accredited investors, for smaller investors to be able to get involved, such that you could advertise maybe more generally than you could otherwise. So
I'm going to answer that in a roundabout way. In 2013, which is the first full year after adoption of the Jobs Act, there were about 10,000 offerings, using very round numbers, that used this ability to generally solicit and generally advertise from the public. And they raised probably about $10 million over the 10,000. Right? So this across the country, across all industries and sectors. From what we know, that's sort of the basic number. In that same period in 2013, there were probably, 100,000 sort of old style offerings, private, where they didn't use this ability to generally solicit and advertise. And they raised, again, many, many multiples of $10 billion. So for some reason, the SEC knows this. People are not, the vast majority of people who need capital are not using the new rules. They're doing it the old-fashioned way, which is, I'm only talking to you if I know in advance that you're an accredited, sophisticated investor. And if not, I'm not going to generally solicit, I'm not going to generally advertise. And people are wondering why. Why? This is like the greatest thing since sliced cheese. I can literally advertise to anybody and sell my securities. Why don't people do this? And so there's a bit of a discussion as to why. The SEC is sort of flummoxed itself. Because, it's odd when the SEC comes and says, yes, you can, and the industry says, we're good. Right? It doesn't happen that often. And so the thought is, one, we've grown up, at least in the United States, with a real heightened sense of fear or risk adverse in the security space. So everyone in this generation has grown up knowing if you're doing a private offering, you can only do it to sophisticated investors, and you can't advertise. That's just the way we've always done it, right? And so now they say, now you can advertise. People think, well, but if I can advertise, and this is really the rub, if I can advertise, who knows what the cat will bring in, right? Who knows what kind of investors I'm going to get? Maybe I'm going to get, people who are looking to invest a little bit of money in my company, a little bit of money. Wait to see if I fail and then sue me. Maybe the kind of, in other words, I know that if I'm bringing in sophisticated investors, I know. I'm trying to use an example that's tactful. There's a subsection of our economy, retail economy, where the fancier the store and the more expensive the product, the fewer returns they have, the fewer complaints they have. Because the people buying that are not money sensitive. They're people who have money, they go in, they spend the money, and if it works out, it works out, if it doesn't work out. Very broad. Obviously, there are many, many exceptions. Whereas if you go to the Kmarts and the Walmarts, there's always a very long line at the return counter. Because people in those stores are very cost conscious, right? And they can't afford to have bought something that doesn't work out, or something that's broken, or something that doesn't fit their needs. And so the thought in investing is the same. if I only sell my securities to people who are so sophisticated and affluent that they can afford to lose all their money, I'm going to do better off than if I sell my securities to people to whom this is their only investment. And if they invest in my company and it goes bust, which it might because it's a new company and who knows what tomorrow brings, they're going to be so angry at me that they're going to sue me. I might be better off going high-end, high-market, even though that restricts my ability to market freely, because I'm less likely to be sued, I'm less likely to have complaints, I'm less likely to have to hire people who have to sit all day on the phone answering people's questions. Did you build this? Did you send the furniture? Did you build it? Right? I don't have to do that because I have high-end investors who know that it takes time, who knows that there's volatility, there's good years, there's bad years, as opposed to, you know, my brother he works for an institutional broker down in Florida. And my mom, God bless her, calls him and says, you know, buy me shares of XYZ company, but buy it at the low of the day. Right? This is funny for anyone who knows the market because you don't know what the low of the day is until the day is over, right? But that's the way people whose money is sensitive, right? Like my mom, they want to know they're getting a good deal. They want to know that it's a bargain. They want to know that the investment is going to do well. They want to know that in advance. And they want to guarantee. And so these rules make it easier to take money from those people. But not everybody wants that money. I guess maybe that's a long way of saying it. And so because of that, the actual crowdfunding rules that allow you to take money from unaccredited investors, right? They're coming. They've been proposed. They should have been finalized already, but they haven't been. Largely because the big players in the industry are not pushing. No one's calling the SEC. One of the rules, right? Because it's only very, very small players who want that access. So that was a cynical. That was an insider view as to how it works. Yeah, sorry.
So this is maybe a follow-up on that point. So who are I'm curious, who are the players who are entering the market, particularly in sort of the real estate equity bucket?
So that's an interesting question. Let me try and explain to you again in a roundabout way. I went on a pitch for our firm. We went to pitch. As Rufus said, our crowdfunding practice is new, because crowdfunding is new. But you know, ours is a real estate-focused crowdfunding because our firm just happens to be have a large real estate practice. And so we had a client that called us. I want to open up a real estate crowdfunding platform. Can you come pitch? So we came to pitch, and he says, a young guy, and he says, you know, why do I need you? You know, I get such and such a firm can do that, such and such a firm can do that. Why do I need you? You know, we were new to him, and he was asking. And so what we said to him was, you don't need us. I'm sure there's another firm who can do the securities law aspect of that, you know, just fine. I'm sure there's another firm who can do the IP part of that just fine. I'm sure there's another firm who can do the broker-dealer regulation of your platform just fine. And I'm sure there's another firm who can do the underlying real estate deals just fine, right? But we can do all of them just fine. And so that was our pitch. We didn't get the business, but that was our pitch. But that's really the case here. So there are people here. So there are. Think about. You know, this is just the front slide on it. There's a whole deck here that I haven't gone through, and there's other pictures. But people like Fundrise and Realty Mogul or Platform, the people behind those are software engineers, right? Those are people who are enamored of e-commerce. Those are people who might be starting again, like an eBay or like some other e-commerce site. They have plugged into a way to raise money this way, right? And then they bring in expertise from the side. But then there are people who are the real big players, are the people who are doing the underlying business. That's the key. The people who are doing the furniture maker, that's who's the large furniture maker, or you know, in our case, the big real estate developers. They're the ones who are developing the platform. Those are the people that are behind it.
The big developers are entering this market.
Correct.
For them,
Correct. So and
access access to capital issue as much as is there a cost of capital?
Right, so in real estate, everything's about capital, right? It's all about other people's money. It's all about investing in every building that you buy. It's 20% equity, and again, just using numbers, and there's a very large amount of either debt or other people's money, right? And so, again, this is not a bad thing. This is the way real estate investment is done. And so, for the real estate investors, they don't advertise on Fundrise. As I said, they're like the Swiss watchmakers. They have their own fancy portals. You know, there's not that many of them, but they're working on them. And you know, when you go on their website and you read about all their properties, there's a little link that says, if you would like to read about opportunities to co-invest with us, please click here, right? And if you click there, it either will take you to a white label site, so it's hosted somewhere else, but it's their brand, it's branded with their name, or it's a site that they in fact have built themselves and are housing it sort of within their structure. And that's just the real estate industry, but there's the same in every industry. Those who are crowdfunding, again, it's either the aggregators like the Fundrise Realty Mogul, or it's the individual companies if they're large enough and sophisticated enough who want to have a direct line of access to the public, to their markets.
And do you see sort of a lot of developers moving into that market?
Yes, yes. Well, let me rephrase. A lot of developers call us to talk about it and ask about it. You know, until it's momentum based, right? Until enough competitors raise enough money to fund enough projects such that people feel that they really need to have this, you may have a lot of people not have it. Sort of the way.
Assuming there are bad apples that take advantage of these lax regulation, do you see any other solution besides just giving it to the SEC to regulate? Because isn't it true that the SEC is already severely underfunded in terms of like the resources?
So that's like a policy question that I can take a stab at, right? Because that's right. What do you do? Like, think about the Glass-Steagall Act or the Graham-Lilly Act, right? These are all rules that once upon a time, when the banks were going out and doing proprietary investing that was thought to be irresponsible and create conflicts of interest, so then there was lots of legislation to restrict banks from doing that. And then under the Republican administration, they went and they undid all that and they allowed the banks to do it. And then we had the financial crisis 2008. Oh, I see, look what you did. You took it about, no, but now I want to go and put it, right? So now there's the vocal rule. So it keeps going back and forth as to how many times we're going to police the same things. And I think what we've learned is that given the opportunity, bad people will do bad things. That's certainly what we've learned. Given the opportunity, and not necessarily bad, but you know, people will push the envelope and they'll be a little greedy, and you'll end up with a crisis. And there's no question it will come here. And if it's a one-off, if it's a two-off, if it's a 20-off, I think the SEC will police it. The Justice Department will police it. There'll be enforcement actions. They'll make a lot of these companies are walking around right now with a target on their back, right? Because the SEC is looking, they're actively looking to make an example of somebody, right? Because the best way to deter bad conduct is to make an example, a very big example of somebody who's done something bad, right? It should be a tremendous enforcement, a huge penalty, some prison sentence, something terrible to deter people from doing it. So there's enough of those, right? That will act as a deterrent. At least that's what we believe when we make these rules. It won't stop fraud. It won't stop some people, but as a general rule, hopefully that will work. If there's an avalanche of fraud, right? If there's an avalanche of people using these types of sites to sell, unvetted or faulty securities or investments, then the whole thing will have to be reevaluated. But that's what we in the industry, we're just on the legal side, but that's what everybody in the industry is really trying hard to prevent, because that will just set us back 10 years. That will set us back to the time when you really couldn't. And if I wanted to invest and lend to you to do for your loan, I couldn't. So we'll have to see how that plays out.
Talk about state regulation in this space. I've seen that some states have been enacting statutes. I didn't know whether they would be preempted by regard to crowdfunding.
Yeah. So that's a great legal question. So the federal securities laws typically will preempt state regulation in the same space. So for example, if I register with the SEC, I don't have to register with any state, even though the states have similar securities laws. If I have an exemption under certain SEC, if I have a Reg D exemption, I don't have to register with any state. I don't have to comply with anything with the state. So the states, though, are coming out and saying this whole mass advertising, that's new. So for example, in New York, you now have to, if you wanted to open up a site like this, you have to file in advance with the state the materials that you intend to advertise, with which you intend to mass advertise or mass solicit. So each state is able to come up or enact their own rules here with what in fact they are or they will or will not be permitted, will or will not permit in terms of mass solicitation. It's just so hard in the context of internet soliciting, right? Because there are, I think they're getting better at it now, but e-commerce for a long time has been a problem for states because everyone's been selling things and not paying state income tax. It's really hard to tell where somebody is when they place an internet, an internet order. So part of that is coming into play. But the shorter answer is that anything that's under Reg D will preempt the state rules, but it will not preempt the state filing requirements for supplemental materials.